Hi everyone, and thanks for checking out my channel. I'm going today to do something a bit different with a video looking at longer term investment that could be actually useful for trading as well, just to get some keeping in mind the long-term trend that we can have on a couple of assets. What I'm gonna do is having a chat about what can be done in the situation where we would have a massive US dollar debasement or loss of value. There's no alternative in terms of the currency in the system today. Can argue that the crown, Norwegian crown, or the Swiss franc could be some alternative, but they are not the size that can actually take over the US dollar. So relatively to other currencies, I believe the US dollar will remain strong, but they basically will all start losing value because of the central bank's action and the plans that are coming soon, mainly due to what happened during the COVID-19. So relatively new, I think, and a complete new environment. We'll need to actually think differently to make sure we can benefit from it and not lose money. I think the first discussion would be in regards to inflation versus deflation, and I think that point is, to me, very much unclear. So we have on one side what we call money printing, which is quite misleading, because the money printing is basically increasing the money that is actually moving in the system, and that's not currently the case. Since the money printing we have at the moment is through quantitative easing, that is technically a swap of asset or incentive to actually go into more risky assets. So the money doesn't actually go into the economy. It does at some point through credit, but that's erased really quickly when the credit is paid back. So that kind of money printing doesn't actually create a lot of inflation. You need for that to see the money flowing into the economy, and you also need the velocity of the money to increase significantly. At the moment, the speed of the money is very slow. It's been probably slower it's been for quite a while. So, and even if there's a lot of money available over there, out there, it's not actually getting into the system yet. So risk of inflation, yes, but still not showing yet. So deflation, in my opinion, the deflation will be here for quite some time because of the amount of debt that we'll never be able to pay back. So no countries will be able to pay back the debt, and they will remain under that massive debt for quite a long time. So deflation will take over, in my opinion, inflation until we get some real money flooding the system and getting into the economy. It might come, but I wouldn't actually bet everything on it. So looking at three assets that can actually protect against US dollar debasement, assuming that we could be both in sort of an inflation on one side and deflation on other assets. The first one is gold, of course. Gold is clearly protecting against inflation and against the USD losing value, so that's definitely a key asset to hold in any portfolio or investment. So looking at the chart, so this is the monthly chart, so we can see from the high of 2011, that was nearly topping 2000, that we enter some massive consolidation move, or what we could call continuation move, in the form of almost some sort of a cup like this. Now we are currently pressing against the waterline, if that's what could happen, which would mean that the price would actually drop back down somewhere here, correct, and form some sort of the handle before we actually see the proper breakout. The problem with that scenario that I see is that it will take a very long time to actually materialize. Like, we're talking about 2023, or like 2 or 3 years away, which in my opinion is too much. We are going to see some more pressure coming before that, and yes, that's I don't believe this is really something that can happen. So in terms of the objective, I believe that we could either get some consolidation or actually breaking out very soon, potentially this year, for a target around $2,500. So that's about 40% from the current price, which is sitting just below 1,800. In terms of the buying level, so if you don't hold gold yet, it would be probably a bit risky to enter here on that level. Either we get that breakout higher, can potentially get in over there, like around 1800, or wait for some more consolidation back down to 1600, but keeping in mind that that correction might not happen and the price might actually shoot up really quickly to the upside. So yes, a little bit risky to wait, but in the same time there's also quite some risk to get some false breakout. No indication of that on the chart, but yes, that could happen. So that's about gold. Now, a second one that I will definitely consider moving forward is Bitcoin. Bitcoin, similarly to gold, has been washed up during the last crash on the market, but don't believe that was because it was not actually protecting or working as a safe haven, but rather because of margin calls and basically traders needed and the funds needed to get the cash from wherever they could. So they liquidated these positions in gold and Bitcoin, but I believe that if we have to see a bear market in the coming years, that these two will not actually get washed out the same, but they will benefit actually for loss of value on the stock markets. Of course, if it does crash again, then they might get liquidated with it, so that's definitely a risk, but I believe that risk is less likely now, not at least the similar crash we got with the COVID-19. So the first thing is the US dollar loss of value protection. So Bitcoin is definitely working together with gold on this. And looking at the chart, is a little bit more active. So this is the the weekly chart, and as I showed in another video, we clearly have that cup and handle configuration, which is a continuation figure with the waterline sitting at 12,000, which is the next target when we'll get the 10,000 broken up. In terms of the buying levels, so we got the weekly 200 MA, it is running basically at 5,900 at the moment, which is roughly down here, and is supported as well by the trend line here that worked well during the last crash. And yes, should the price break down that low, which it might not, and it might just continue and break the 12,000 and reach the target, then yes, there would be a nice entry point down there, but as well, and not highly confident we'll get there, but it's a possibility. The breakout will take us to, let's say, 20k, potentially overshooting it, but that would be the target for this. That's about 100% profit on that position on the Bitcoin from the position from today. So yeah, definitely very interesting asset to hold. Asset number 3, which is a little bit working against the first two, because this is more protection against deflation. So not protection, but basically would benefit from deflation, is the holding the T-bonds for the long maturity, like 10 years or more, because that's the big protection against a really high debt level. I believe in the current environment, definitely the QE and all this will continue to do whatever is needed to keep the yield as low as possible, and that will benefit to the T-bonds as well. So as we look at the chart again, monthly basis, there's a forever uptrend that is unlikely to stop anytime soon, and we are trading at the moment at the top of the range. That one is on the 30 years Treasury bond. It's running at just around 180 at the moment. So Potentially a correction down is possible to reach the other end of the channel, but which is 150, so I would give that as an ideal entry point at 150, 155, which is the weekly 200 MA. But also keeping in mind that at the moment, should we have any pressure on the stock market from here, or bear market resuming, and we can quickly break out that figure, and I would look more at the moment with what we could actually see. The bull flag starting here, and then we would have the objective on the breakout that would sit roughly around 200, so not a massive gain, but 15% on T-bonds. That's quite a large move, and of course you wouldn't trade the three assets in the same way in terms of how much you're gonna put in each. Bitcoin is very volatile, of course it can drop a lot, can increase a lot, so you don't want to put too much in here. Gold is much more stable in the long term, either you buy it physical or you buy through ETFs. It's probably just a matter of liquidity and how you can actually get in, get out of the market. The main advantage of holding paper gold is that you can actually trade up and down, so that's which you, of course you cannot do if you hold only physical. And in terms of the T-bonds, I'm used to trade ETFs, the TMF, for example, which is the 20 years, I think, and they are leveraged, so which is okay because usually the moves are not that big. And on T-bonds, you would just actually set stop loss somewhere, just in case you have a crash on the obligations. You never know what could happen, so just in case it goes really wrong, just to get some level of protection. Okay, that's about it for that video. I hope you found that useful. If you have any comments about what I just said and any advice other than this, maybe other assets that could be interesting to hold in that environment, please make comments and I'll be happy to share with you. Thanks for watching, and I speak to you soon. Cheers, bye.